If you invest your money, read a financial journal, want to excel at financial planning, and are striving to grow financially with every move, you must have heard of the famous Warren Buffett. Warren Buffett is nothing short of royalty in the world of finances. He is often found on the list of some of the world's wealthiest people. His books are bestsellers and have helped several people achieve their financial goals with greater simplicity and ease. While achieving the same kind of financial standing as him may or may not be possible for everyone, following in his footsteps and applying his retirement investment strategy to your financial plan may be beneficial in many ways. The Warren Buffett investment strategy is a tried and tested strategy that has helped many investors in the past. This simple strategy can be instrumental for investors preparing for retirement, as it offers capital appreciation and the likelihood of a financially stable and comfortable retirement. So, do you want to know what the strategy is? It's called the 90-10 rule. It all came about when Buffett wrote a letter to the shareholders of his company, Berkshire Hathaway. In this letter, he advised the trustees to divide the cash into two categories. 10% of the cash was to be put in short-term government bonds, and the remaining 90% in a low-cost S&P 500 index fund. He even recommended Vanguard. Warren Buffett believed that the long-term gains from this strategy could be better than what most investors get. This letter and the advice from Warren Buffett may be hard to comprehend, but in order to understand this, you must first understand what an index fund is. An index fund is a passively managed fund. Index funds are a type of mutual fund or an exchange-traded fund, ETF, that follows a benchmark index. It is not possible to invest in an index directly, but you can invest in an index mutual fund or an index ETF. Warren Buffett recommends an index fund that tracks the S&P 500. This index contains the largest 500 publicly traded companies in the United States and roughly constitutes 80% of the stock market's value. As a result, they can determine the performance of the market. Since index funds mimic the performance of an index, your funds are dependent on how the index performs. Warren Buffett advises putting 90% of your funds in an index fund that tracks the S&P 500. When this index rises, your index fund also accumulates returns. While 90% of your money is invested in a stock-based index, the other 10% should be invested in short-term government bonds, as per Warren Buffett's Guide to Retirement Investing. Short-term government bonds are used to finance government projects, which makes them considerably less risky. These short-term securities have a maturity of fewer than 5 years. Bonds help to lower the overall risk from your investment portfolio and can be good for diversification. Moreover, they offer stable dividends, interest payments, and the safety of capital compared to stocks. Bonds can also be more liquid, as they offer income periodically. He also advised to avoid high-fee managers, since investing fees can eat into your profits and render them worthless. Moreover, when you are investing on a regular basis, the associated fee can add up to a lot. Even a meager percentage can turn into significant amounts of money over the long term, according to the Warren Buffett investment strategy. Investing in a low-cost fund instead can be a lot more profitable. But are there any shortcomings of this strategy? Surely it's not as simple as it seems to be. While Warren Buffett's retirement investment plan has gained traction and worldwide popularity, it has also been criticized by several investors. By following only an index-based approach with little weightage to bonds, the investment portfolio misses out on one of the most important things: diversification. Generally, financial experts recommend a mix of different investments, like stocks, bonds, gold, real estate, international funds, etc., to ensure better growth and lower risk. This helps to counter the market volatility, as when one investment fails, the other picks up, and vice versa. Some financial advisors also feel that Warren Buffett's strategy would only be suitable for high-risk investors or young investors with a long investment horizon, but it cannot be ideal for older investors. Since index funds mimic the benchmark index, a portfolio with 90% of stocks could be catastrophic to those nearing retirement in case of a recession. Now, should you follow Warren Buffett's 90-10 strategy? There are different strategies to follow when it comes to investing. The one-size-fits-all approach cannot be applied to every situation. So, following the Warren Buffett 90-10 rule is a personal decision for every investor. Using this investment strategy can be ideal for young investors with a long investment horizon, as the chances of risk are distributed over time. If you find the Warren Buffett Guide to Retirement Investing a bit risky and problematic, you can also consider the 100 Rule. The 100 Rule is another popular rule, according to which your asset allocation should be relative to your age. So, for instance, if you're 50 years old, your asset allocation should be 50% in bonds and 50% in stocks. At the age of 60, this should change to 60% in bonds and 40% in stocks. The idea is to decrease your investment in stocks as you age to preserve capital and keep a low-risk appetite. So the percentage of stocks should be the highest when you're young and gradually decrease as you age. Some aspects of Warren Buffett's advice can be helpful for people of all ages. For instance, regardless of your age, saving money on fees can benefit you. The most important thing is to have a clear understanding of your goals, so you can make the right decisions at the right time. On occasions when you're unable to decide what to do or where and how to invest your money, you can reach out to a financial advisor for professional help.